Good morning, good afternoon, good evening, everyone, and welcome to Financial Forecasting Made Simple. My name is Brian Lucksinger, and I'm a vice president of external relations at a venture capital firm called Gangels, but I work as a consultant with the NASDAQ Entrepreneurial Center. For those of you who may not know, the NASDAQ Center is a nonprofit improving access and knowledge in entrepreneurship to advance economic progress for all. As you'll see in the chat in just a moment, the NASDAQ Center provides programs, resources, and exceptional mentorship to help entrepreneurs fuel prosperity, no matter where their journey begins. Be sure to check out the links and resources shared in the chat. I'm going to launch a few polls to step back and take a temperature gauge of how all of you are doing today. We use this information to guide the programs we provide for this global community of entrepreneurs. If there are specific topics or challenges you'd like us to create resources for, feel free to share them in the chat. Just a couple of quick housekeeping notes before we get started. First, let us know where you're dialing in from by dropping it in the chat. We love to see where everyone's joining us from or for our time together today. Second, we'll have a live Q&A at the end of the event, so feel free to submit your questions at any time using the Q&A function at the bottom of your screen. We'll do our best to get to as many as we can. While you're answering, I'd like to take a moment to recognize the incredible support of our corporate partners. The work we do at the center wouldn't be possible without the generosity and belief of our partners and funders, including NASDAQ, Wells Fargo, JP Morgan Chase, KPMG, Walmart, the Asia Innovation Hub, Wilson Sonsini, and the Nareet Foundation, and BPM. We're deeply grateful for their partnerships, and we hope you'll join us in sharing that deep appreciation. Without any further delay, please join me in giving a warm welcome to our special guest, Heather Tuason, founder and CEO of Arena, just named number 409 on Inc.'s 5,000 fastest growing businesses. Without further ado, I'll hand it over to you, Heather. Thank you so much.
Hi, Brian. Great to be here. I need somebody to assist me in turning my video on.
Let me see here. I just prompted, you should get a request on your screen there. Good, perfect. Hand it over to you. Thank you, Heather.
Great to be here. And thank you, Brian, for the warm welcome. We're going to talk today about financial forecasting. There are going to be a number of different things we're going to cover today, and want everybody to take away from the session today what a financial forecast is, why it's important for your business, how to create one. We're going to dive in and actually show you the tactics of creating a simplistic financial forecast for your business, how AI plays into that, because everyone has that outstanding question. And you're also going to get a free template from Arena that is the starting point for your financial forecast. So, Brian, I'd love for you to go ahead and drop in the chat the link to our free tools on the site. By the time we're done with this webinar, you will be able to have your first financial forecast done, or a brand new start to one, as well as a revised one, if that's how you want to spend the time in the time we have today. Let me get started with a little bit about Arena. We offer fractional CFO services as well as accounting services. When you create a financial forecast for your business, you'll want to do one of three things. You do it yourself, a DIY-like project, which is what we're going to walk through today. You can get an assist. There are fractional firms like ours out there, as well as a number of other types of financial experts that will lend a hand in getting this off the ground for you. They're also the full, what I call the full Monty, basically a full service of someone who can come in and put a financial forecast together for you. That's like an in-house CFO, or you hire somebody that is going to run that from an independent standpoint in a full-time fashion. What I tell most businesses, especially ones that are just getting started, like the ones here on the attendee list today, is it's always good to start with something and start it simple. So you have something in place. One of the biggest mistakes businesses make is they do not put one in place and they don't follow it on a regular basis. So let's start off with a little story about a business. So this is Mike Wheat. He owns Wheat's Landscaping. He started off his business 30 years ago mowing the Little League ball fields for his son's games, pro bono. He didn't charge anything. That kind of took on a life of its own as the parents across the fields began to ask him for his services as well. And then what happened is he grew it from there. So 30 years in business, he first started off with regular landscaping, like lawn services, mowing services. And over the course of his 30-year progression as a business, he added things on like landscaping, like hardscaping, as you see in the picture here. He added on things like snow removal. Now, let's just imagine what this does to a small business financial model and really a forecast for your business. Mowing is one thing, right? You mow someone's lawn, you get paid soon after. You add on landscaping where you're purchasing shrubbery, and plants, and that has an upfront expense that you get paid after most times. Some landscaping companies structure that a little differently where they get paid up front. All of this impacts your cash flow. Hardscaping, another very expensive upfront cost for a business to take on, and one lump sum payment tends to be at the end of the project being completed. Mike also has in place snow removal. We live in the Virginia area. He is one of my neighbor businesses in the area, and he has snow removal as part of his services. Snow removal, who knows when that's going to happen? Very unpredictable, yet you have to have the equipment ready to go and maintained. So not only do you have to have the upfront expenses of the equipment itself, you also have to have the maintenance costs for that are ongoing. So all of these, makes a very complex business model from a financial standpoint. Let's layer on to that one of Mike's core principles is he pays his people every Friday, and he never has changed that in 30 years. They love him for that. His whole team really enjoys the fact that they get paid every Friday and they have their company picnics. But what does this do to his cash flow? If you think about his service-based business of mowing lawns and his product-based business of selling landscaping services and hardscaping services, that is going to really impact his cash flow for his business. So I brought this example forward today, really just to demonstrate to all the businesses out there, no matter what segment that you're in, whether you are a professional service-based business or a product-based business, a more retail-oriented business, a financial forecast is important no matter what type of business you are. And hopefully the examples we'll walk through today and the exercise we'll walk through today will really show you and give you the tools you need to really get yours off the ground. So what is a financial forecast? Financial forecast is a forward-looking projection of how your business is going to financially run, what your expectations are of that, the knowns and the unknowns. You know a certain customer is going to stick with you for the next year. That's a known. An unknown is the new business you might acquire. It really gives your business a map for your progression over the course of the future. What it is not. A financial forecast is not the past. It is based on past performance, but it is not the past. So one mistake businesses often make when they create their financial forecast is they just look in arrears at how their business did in the past and incrementally grow it. Well, I would offer that there are other alternatives to look at and that could offer your business more growth. And we'll walk through those in just a minute. So now the scary statistics. 90% of businesses do not have a financial forecast in place. This is really scary because it tells you that 90% of businesses out there are kind of flying by the seat of their pants. They are trying their best to make ends meet, but not in a planful way. Some businesses have an expense-based budget, but they do not have a financial forecast. And let me tell you about the difference between the two. An expense-based budget is just how I'm going to spend money. It has nothing to do with how you're going to make it. And the absolute biggest mistake businesses make when they put together their projections and their financial forecast is they think about it backwards. They think about their expenses before they think about the revenue. It's not like your household budget. In a household and your personal life, basically you have a fixed amount of income that comes in. Most households do. So therefore, the only variable that has decision-making around it is the expenses that you spend. So oftentimes a household just creates an expense budget. A business needs to think about that in the invert way. they need to think about it from a standpoint of how much money do I want to make this year, and then think about what it's going to cost me to make it. So let's step through a little bit more around some of the statistics around businesses that don't have one in place, and hopefully that encourages each one of you out there to either do it yourself, put one in place, get an assist to help with put one in place, or have one of your financial professionals on your team do so. If you don't have a financial forecast, banks will not lend money to you. And as Brian probably knows, investors and venture capital and PE firms are not, they are very skeptical of what you're going to do with their money. So a financial forecast basically gives them the roadmap for how you're going to spend their funds and make more revenue. Employees aren't driven by financial goals either if they're not put down on paper. So why does your business need one? Well, 82% of those failed businesses, they cite cash flow as the reason that they failed. So this is a quick and easy tool to get you started, but the key to this is maintenance, is setting yourself up for a monthly business review to see how you did based on the projections that you made. There are, as of Q1 of 2025, 61% of invoices sent to clients are outstanding. They are delinquent. They're past the due date. This is a problem when you expect a client to pay and they haven't. So this is another reason why a financial forecast tool is very important to put in place, because if you have late paying clients, then what you can do is project that out and actually see if you can afford your expenses for your business. Or you might need a capital infusion. And only 16% of businesses get funding from their bank. I think this is an astronomical number. And there is a lot of funding to be had from banks at a very low cost of capital. One of the main reasons, no financial forecast in place. And just a side note on lending with a bank is that once you put forth any type of financials with an underwriting team at a bank, you really need to have your best foot forward. So make sure you've dotted your I's and crossed your T's before you submit any financial information to your bank or any other investment partner. So why it's important for your business in particular? Well, outside, we just talked about the lending component. Anytime somebody is going to give you money, they want to know that you're going to be prudent about how it's spent. They want to know what it's going to take to get your business to the next level, and that you actually know the levers to get your business to the next level, whether that's marketing, employees, more technology, whatever. So that's an important driver there. New employees, too, often ask about the financials of a business, especially a smaller business. They want to make sure that the business is viable, that they can pay their paycheck in 6 to 12 months. So oftentimes, a smart applicant for a role at your company will ask about the financial position of your company. So be ready with some of those numbers and not necessarily divulging every single expense category, but some top line numbers that can help satisfy those inquiries. Inside your company, it's also very important to have a financial forecast. This drives the goals of the company. It is the sole factor that if you do not have your ambitions out there for the rest of your team, how can you expect them to actually achieve them? It also gives them the expense amount that they know they can have allocated to them to achieve those goals, whether they can hire a new person, do a marketing campaign. So being transparent is an important fundamental about the financial forecast. There are a lot of business owners out there that just haven't put that together for their team, and their team is wandering. And if they do not have the transparency into where the company is going and wants to go, they really struggle to achieve the objectives of the organization. Here are the biggest forecasting mistakes, and then we're going to dive into making one. Oftentimes, businesses create a financial forecast that is too complicated. It has too many line items to manage. Therefore, when the actuals come in at the end of the month, they have a hard time mapping it together to know In my marketing category, did I spend too much or too little? Keep it simple. And we'll walk through some of those categories of a very simplistic financial forecast today. You get too precise is another mistake that often businesses make. If you are striving for too much precision into the dollars and cents of each expenditure or each revenue category, then you're also setting yourself up for failure. Do your best guess. The reason you're setting yourself up for failure is because then you consistently say that you were wrong. So be general in it. It's oftentimes you will put general numbers into a financial forecast and precise numbers into your actual performance. The other big mistake when someone creates a financial forecast is they put it on the shelf. They don't revisit it on a regular cadence. Our suggestion is that you do this on a monthly basis. You understand your deltas between what you expected to happen and what actually happened, and you talk through the difference as to why it happened and implement any needed changes. And of course, the one I've already talked about, which is businesses detailing the expense base before the revenue base. So we're going to break this down. We're going to start with how to build your revenue forecast, because that's the most important first step in creating your financial forecast. We're going to consider these things. We're going to consider prior performance. If you do not have prior performance and you're a brand new company, things to consider are competitors in the space, peers in the space, as well as any testing that you have done, and you can extrapolate and actually multiply out to be what a prior performance could have been. Any type of demos or test clients you may have had. Any new ambitions that you have as a business. I want to hire 3 more people. I want to consider a marketing campaign this year. I want to XYZ. Any headwinds that you may have. Tariffs, big one, right? And when we had the pandemic hit, a headwind that we didn't know what it was going to do to each of our businesses out there. So these are things to really zoom out from the day-to-day operations of your business and think about prior to putting a number on a cell in a spreadsheet. Think about that. All right, I'm going to walk you through here a lightweight forecast. This is the one you can get off of our website. We have 2 versions out there. We have a lightweight one and a heavy-duty one. What I will say with this is you can start your forecast with how many customers you have or expect to have in January of each year. And let's say, for instance, a client pays $1,000 for that product or service. You can extrapolate out exactly how much you would make month over month, and your ambition of the final total being something that you aim for, how much money I want to make in this year or this time period. So you can make adjustments to this. Seasonality could be an adjustment that you might want to make. If we go back to the example of the landscaping company, where a majority of their income comes in between May and October of every year, we should apply seasonality to this. So we would actually say, well, we'll probably get more customers in the April-May timeframe. So let's index that there. That would also impact, of course, my expense base when we get to that. The other things to consider as you build out your revenue forecast are marketing campaigns. Marketing campaigns, if you do some tracking and understand when you implement a marketing campaign and when it impacts your top line revenue, then you can actually detail out what month you expect more revenue to come in as a result of that marketing campaign. So the ambition here would also be to break out your revenue by product and service sold. And there's a reason for this. And the reason is you want to know which products are bringing you the most money, right? For the most profit margin. And we'll get to calculating profit margin at the end. But from a revenue perspective, you really want to get to a point where you don't have one line of revenue, as in this lightweight forecast. You want to build on that and actually list out the products and the services that you sell, so that then you can get the unit cost of each one of those and understand the profit margin of each one. So let's jump into how to build your expense forecast. Again, taking into account prior performance. What did you historically spend money on? The team that's in place, the marketing, the infrastructure, the technology, etc. So think about that. So a good tool to do this is to pull 2 years of past performance if you have that. If you don't have that, again, a peer set can be leveraged to build your very first one. Another tool for both the revenue and expense forecast to leverage is AI. Ask ChatGPT, a number of other sources out there. Ask what the prompt would be something to the effect of, what is a first year revenue top line for a company like mine, and describe your company. Marketing drivers here are something that is really important that you put in the proper month. We have a number of businesses that come to us and they have ambitious growth. They want to grow 10, 12x in a year, something to that effect. And if that's the case, you know you're going to have marketing spend. You know that's going to have to come earlier in order to impact that year. So make sure that you're thinking about when the marketing spend is going to happen and the additional employees, should that be needed, additional inventory or product or additional technology to enable that type of growth. And make sure that that's slotted in ahead of time. So you want to make sure that that's in plenty enough time so that it is achievable. One mistake that businesses make is they say they want to grow 12x, yet the marketing spend that they need to grow 12x, they don't have enough money for. So they need to space that out over the year. So then they need to adjust their ambitions over the year. The other thing it really signals is whether they need to raise capital, whether they need to tap into their venture capital partners, private equity partners, private investors, their own personal funds, or a bank loan. Employee drivers too. Think about a couple of things in this category. Employee drivers in an expense base can really be detailed. Some people just think, I just don't want to hire one more person and I'll be good. And to know that, you really need to take into account the benefits, the full loaded costs of that employee. So that would mean both their salary, their benefits, and any other perks that they have that you've added to the broader employee benefit suite. So let's walk through an expense forecast. In this example, we've broken down marketing, payroll, equipment, and inventory in relation to really the landscaping company that we detailed. We realize that it is a little lumpy. They do marketing periodically on a quarterly basis. They do a big push. And then their payroll stays pretty consistent until you get to the summer months. Equipment also stays pretty steady because they have that financed. And inventory of the brick and mortar that they put in for hardscaping and the shrubbery is in place and also increases at certain times when they actually see sales in the market to obtain inventory. So here you can get to a point where if you list out broad categories, it is much easier to see what your net income would be. In addition to this, once you get to this point, and the number of expense categories is up to you, you can do stress scenarios. Stress scenarios are things like the pandemic, tariffs, a competitor down the street just pops up and takes half of my income away. It can be anything. In this particular example, we did the pandemic. Everybody started to do their own gardening. So we took basically about $6,000 of revenue off the top in March through December. And you can see what that will do to your ultimate net income. I typically apply multiple scenarios, a more lightweight scenario, such as a competitor, and then a more heavy duty, oh my gosh, it's something we never expected, like tariffs. Then you can calculate profit margin. You can also calculate profit margin by product. This will be important for you to manage to know if you need to adjust your prices in any way. Another big mistake businesses have is they often wait too late to increase prices, especially the small guys. From there, I'm going to open it up to questions. And while we wait for Brian to start to queue up some of the questions, I'll just give a couple other tips. Make sure that you have your business review, even if it's with yourself, once a month. And it can review past performance. It can also review if you want to make any adjustments to the future. The key is regularity and discipline.
You
So let
already
me turn it
answered
over
the
to you,
first
Brian.
question. Yeah, you already answered the first question. So it's good. The first one was how often should we update the financial forecast? So went into that perfectly. Then we have a second one here that says, but do larger companies, for example, those with billions in revenue, need complex and precise forecasting?
The larger you get, the more complex your forecasting will become. You'll naturally get to a point where you need to have a more full service type of financial expert overseeing your business. And they do so for a number of reasons. You really need to slice and dice your analytics in a much more detailed fashion the larger you get to make improvements. And that's really the fundamental thrust behind the complexity in the models. The other reason that complexity in models for a larger company is important is for fundraising. Really, there are a lot of, when you have more investors, you are going to have more eyes on your financials as well as your operations. So to make sure that that's detailed in a way that satisfies those investors and funders' requests is important.
Couldn't agree more. Love that answer.
I know you couldn't.
You're on my side of this business. Next question says, how do you know when to bring up the prices to keep it balanced?
So when your profit margin gets too thin, and what that means is this, is every industry has a target profit margin percentage. It's a range. It's between 20 and 30%. It's between 30 and 40%, depending your industry. ChatGPT can answer this question for you for your specific industry. What I will say, if you're ever at 5% or below, you're in trouble. If you're at 20% or above, it tends to be a good sign that you've got the right pricing structure in place. But oftentimes, people do not measure their profitability and their profit margin on a regular basis enough to even recognize the fact that their costs have started to creep up slowly and their prices are still the same.
Amazing answer. Your next one is, how many years shall an e-commerce do forecast for fundraising?
A 3 to 5 year projection tends to be the going, right? They might ask you to string it out a little longer. The dilemma with bringing your forecast out multiple years beyond that is the fidelity of the forecast. It becomes too there are too many variables that are going to influence it. The assumptions are just too vague. So a near-term forecast of 1 to 3 years is important to have for a business. I do find that if you're going to get a big fundraise done, you possibly need a 3 to 5 year.
Couldn't agree more. Your next question, actually, it's a comment. Rosie is just curious if you would be able to pull up the last example of the revenue forecast just for a moment. I think she may want to take a screenshot of it.
Oh, sure. Absolutely. The revenue forecast. Here we go. There you are, Rosie. Here's the screenshot.
Perfect. And as she gets that taken care of, we'll move on right to the next question, which comes in from Jajaya. Also, for the new DTC company, there is more spending up front, but not much revenue in the first few months. How to use that performance to forecast?
If the expense base of a company is heavy at the onset of the company, then you want to institute a metric called the burn rate. So that is how you're burning through the cash that you have available to you and how much more you have left.
Burn rate is the lifeline of the startup community.
Right.
Anonymous attendee asks, what's the biggest mistake people make when forecasting?
We ran through a couple, but I think the biggest one in my mind is they think about their expenses before the actual revenue. And it's because they're so deeply ingrained in the operations of the business and making payments out. It's just more front and center for a business owner to think about the expense base of a business versus the revenue side.
Perfect. Rosie did have one little note here. She said, could it be the final example of your forecast? Thank you. I use it in a similar format. Curious how yours looks. So I think she just wants to see the last example as well, maybe.
Sure. Absolutely. And you can also, Rosie, get this on our website. You can download it.
Perfect. Dave Miller came in and asked, what is a red flag of a profitable business running out of cash flow?
What's a red flag?
What is the red flag of a profitable business running out of cash flow?
It could be the way they get paid. This is a something that we see in businesses often, where they basically bill their clients. If it's a professional service business, they bill their clients after the work is done. Then they wait 30 to 45 to 60 days to get paid. And as I mentioned at the beginning of the presentation, 61% of invoices are being paid late. So red flag right there. Follow your aged receivables, meaning people that are paying late and they're aging. So definitely keep track of that. Incorporate it into your monthly review. Who's late? Let's follow up with them and find out what's going on. And then start to get proactive about that as well. There are a number of things you can do to get paid more in advance. Think about shifting your payment model altogether. Think about getting paid in advance. Professional services, I always recommend a retainer-like subscription model. That way you're getting a regular set proactive payment ahead of time. And then you're truing up with any type of kind of extra over-the-top expenses from that. The other thing is really doing any pre-orders you can. Think about the Starbucks gift card, right? That everybody puts money on their Starbucks gift card. You actually just paid in advance for your coffee. All kinds of tools like that.
Amazing, Heather. So we just finished out the Q&As that we have in there already. So I do want to open up the field. If anybody, I know we have 50 participants on, so if anybody has any outstanding questions, I do have one myself as somebody who listens to a lot of these pitches. Is there a specific question that you think CFOs should be asking their teams when building out financial forecasting, whether that's in regards to certain metrics or just ways to visualize the data that you don't think they ask enough?
Is it achievable?
I
think there are a number of ambitious financial models out there, ones that have exponential growth rates. And it's not the CEO that's making this happen. It's the team. And that's why, being transparent and sharing your ambitions through a financial forecast and sharing that with your team is helpful. But the big question to ask is if it's achievable, because numbers are only as good as they are on the page unless you can achieve them.
Couldn't agree more. I think the achievable is the number one thing that we look for in startups as they come to the table with it. I mean, a lot of it is projections and a lot of it is goals, but is it realistic at the end of the day? Like, can you, given your constraints and your investments, get to the points and the factors that you're saying you are? We did get a question that just came in that said, as a skincare brand, consumer purchase is unpredictable. What's the fair way to estimate revenue?
So I don't know how long you've been in business, but if you have been in business, more than a year, I would go get an average across your months to begin those projections. If you do not have that in place, or you don't think those are the right numbers to look at because you were kind of in test mode during that time period, ask ChatGPT. Get specific on your prompt. This is something that I'm learning more and more about. But really, as a prompt, the more specific you can be on specifically the health, the skincare, lotion product, whatever it may be, what is the price point that might work? And then that can help influence some thinking and what you should put in your sales.
Jajaya, who asked that question, just clarified they've only been in business for about 5 months so far, if that changes your answer.
I would definitely leverage some AI tools for that. And also just looking across, like, you can have ChatGPT actually look at your aspiring competitors and do averages for comparable products.
Love that. So we have a question coming in from Kieran that says, how do you financially forecast for the seed funding round, especially when no market test data is available as the product is yet to launch?
Yeah, this is a hard one. And this is where folks like Brian really have to have a lot of faith.
That's the truth.
Yes, yeah, that's the truth. Really, you need to think about your assumptions and be very detailed about how you think about those assumptions and notate them well for folks like Brian to really read through if you're fundraising. So an assumption would be, I can sell 10 products a month at $50 per product. right? But why is that? You really need to dive into, because my competitors are charging 75 and I think I can charge 50. So getting really detailed on what those assumptions are will give folks like Brian much more confidence and in the funding round for that. So the other thing you'll think about as you put together your pitch deck and you put these financials in there is you'll want to have a flexible financial model, because no doubt Brian's going to come back to you with questions. I don't believe the $75 number. Prove it, or ratchet it down a little bit, whatever that may be. Brian might also want to actually step into your model and actually look at your formulas, etc. I've seen that happen with a number of venture capital firms. Well, let me just take a look. They want to make sure your formulas are right. They want to make sure the details are right, because they're putting their money on the line. So those are a couple of tips on your financial forecast if you do not have a good historical performance perspective to bring in.
Incredible answer, Heather. I could not agree more. And thanks for putting me on the spot. No, just kidding. I promise I won't I promise I won't break into all your financial models. So we have answered all the questions. I do just want to give it one more minute to see if anybody has any other questions. We got Anna McCorvey coming in here saying, what are the main differences in doing this for a service-based company versus a product-based company?
There are significant differences. One is, so as you think about building out a service-based financial forecast, really your revenue is around that. How many clients can I get? When are they going to pay? So really think about that in the revenue portion, building out your financial forecast. The expense side of that, really the biggest levers are people. So a balance of W-2 employees that are on your payroll and have a long-term relationship with you, as well as 1099s as you get started, which are contractors, typically are a very good tool to help flex that up and down in the early stages of a company. And there are a lot of people out there that are seeking 1099 contractor work to help with that. So you really want to hone in also on the profit margin by service sold. So try to get specific on breaking your revenue down by that, and also breaking down your employee or contractor expenses in relation to that.
Incredible answer. And we just actually read a model the other day that said over 50% of employees are expected to be 1099 in the next 10 years, which is so interesting to me.
Wow.
Massive shift. But it's the gig economy. That's what people are noting it down to. So we have answered all the questions. I do have one last question we always ask from the NASDAQ Entrepreneurial Center that I will round out today. And if anybody has any additional questions, feel free to drop them in the chat as I ask this. But Heather, if you were to leave all the people on today's call with one key takeaway from today's session, what would that key takeaway be?
Create your financial forecast and visit it monthly. Simple to do. It takes 30 minutes to build one, takes 30 minutes to review one. It really doesn't take much, but with 90% of businesses not having one and 50% failing by the time they get to their 5th year, citing cash flow as the issue, this is the tool.
Mm-hmm. I couldn't agree more. I think this is one of the most important things people need to keep in mind, and also ask as many questions as possible about as you start to build your companies out. No matter where you're at in your journey, you should always be revisiting the models. And Heather's obviously an incredible subject matter expert on this, and always willing to work with individuals. So I know there are some links in the chat to follow up with Heather directly, but I did just want to say thank you so much for taking the time to speak to our community today, share your insights, and set such a great overview on all of this. And on behalf of the NASDAQ Entrepreneurial Center and everyone in attendance today, we sincerely thank you for joining us. We would love for you to join us for upcoming webinars for all the attendees on today, and you can view those upcoming events by using the link in the chat. Thank you all so much for joining us today. We look forward to welcoming you back online with us soon, and we will make sure that you get all the extra links from Heather and Arena after this that you can follow up directly as well. So thank you so much, Heather. Thank you for everybody for attending today. And thank you, Michelle, for coordinating all the pop-ups and key polls that we use today. All right. Thank you all. As always, from the NASDAQ Entrepreneurial Center, we'll see you soon. Thank you.